Is this the end of ESG? After spreading worldwide and shaping how companies operate, ESG policy now faces a strong retreat from its own champions. Most notably Blackrock, the investment giant managing over $10 trillion, which is beginning to show signs that its commitment to the concept might be waning. Recently, BlackRock has been scaling back its support for the ESG agenda and shifting focus to other areas for the future. Now, the debate centers on whether ESG was truly a useful idea or just a market maneuver. In this video, you'll learn what ESG is and why BlackRock and other companies are now turning away from it. Over the past few years, the world has become familiar with ESG, an acronym for environmental, social, and governance, known to us simply as ESG. The concept is based on the idea that companies should be guided by a set of best practices that can make the planet better, both in terms of human interaction and in humanity's relationship with the environment. In theory, the concept encompasses a variety of issues, including the need to care for the environment through carbon emissions control, responsible use of natural resources, waste management, and addressing climate change impacts. In the social sphere, it examines a company's impact on society, including how it treats employees, customers, suppliers, and the community at large, covering topics such as human rights, labor relations, and diversity and gender equality. Finally, in terms of governance, companies are expected to follow parameters ensuring transparency, ethics, anti-corruption measures, and structuring of their boards of directors. The concept was introduced into society over the years, and its significant implementation milestone occurred at the UN in 2004, when the entity launched the Who Cares Wins initiative, encouraging investors to adopt more holistic approaches when investing in companies, factoring in considerations beyond profit alone. With this background, the idea was embraced by numerous corporate figures and global leaders, with some of the largest financial institutions becoming major backers of ESG. The most prominent financial player to adopt the concept was the famous BlackRock, an investment firm managing $10 trillion in assets, which not only championed the movement, but also incorporated ESG as a criterion for global investments. BlackRock, largely through its CEO, the notable Larry Fink, became the biggest advocate for the concept. Alongside BlackRock, other large firms such as State Street, Fidelity, and Vanguard adopted similar stances. The ESG framework began to dictate how they allocated capital, in what became known as green or even woke investing due to its alignment with the values of the woke movement. Not only that, but these investment firms also created financial products containing only companies that adhered to or promoted ESG criteria, such as ESG-labeled mutual funds and ETFs. BlackRock notably manages two of the 5 largest ESG-focused funds, with more than $48 billion in assets under management. In all cases, asset managers evaluated how well global companies met ESG criteria, and if they did not meet a minimum threshold, they would be compelled to improve their scores, or even lose funding, as managers would immediately sell off their shares in the market. This pressure stemmed from the fact that these asset managers, along with other financial institutions like Morgan Stanley, held significant stakes in some of the world's largest companies. Simply liquidating these holdings in the market would not only strip a company of key investors, but could also cause its stock price to plummet. Since these major players can dictate the overall direction of the financial market, it didn't take long for other market players to adopt the same approach, directly or indirectly. This created a multiplying effect, reshaping investment standards globally. In other words, ESG became not only a benchmark for investment, but also a guideline for divestment, serving as an indirect tool for pressuring companies. If they wanted access to capital, or at least to maintain their valuations, they had to follow this benchmark. This influenced not only how the financial market invested, but also how business relationships formed between companies. For instance, a company that met ESG standards would only do business with another company that also adhered to ESG criteria. This shift transformed all interactions between large corporations, even affecting advertising practices worldwide. After all, no one wants to lose market space, whether from a lack of investors or even a shortage of buyers. Companies that supplied goods to others had to conform to ESG standards to continue trading with companies that had already embraced ESG. This pressure for immediate change was driven by fear of divestment or business obstacles, as emphasized by Larry Fink himself from Blackrock. Put simply, if they didn't follow these guidelines, farewell.
That's an investment criteria for you.
Well, behaviors are going to have to change, and this is one thing we're asking companies. You have to force behaviors, and at Blackrock we are forcing behaviors. What we are doing internally is, if you don't achieve these levels of impact, your compensation could be impacted, okay?
We're doing the same thing.
And so it's just, you have to force behaviors.
Through this structure, ESG has become widely implemented over recent years, not only in publicly traded companies, but also in privately held ones. This explains a series of policy changes within companies, from new hiring practices to reimagined business approaches. In short, ESG implementation over the years has created a complete shift across society. First, the financial market gained a new investment orientation. Then, companies had to adapt to this new reality. Subsequently, it even affected how society viewed businesses, as expressed in the media, whether in journalism, movies, series, or on social media. However, not everything is rosy when it comes to ESG. Despite its good intentions, the agenda generates considerable criticism. The first is that implementing these policies creates a vast array of obligations and responsibilities for companies, which are costly and could impact efficiency not only in the short term, but also in the long run. This could ultimately drag companies down over time, forcing them into a social role that isn't part of their core mission. The second and more significant criticism is that behind the appealing rhetoric of opposing profit at any cost, ESG could actually serve as a way to greatly boost profits. This is because, as ESG demands a series of costly practices and conduct, only the largest companies in the world can realistically meet all the requirements. Implementing these criteria is expensive, both in the present for initial adaptation and in the future to maintain compliance. This could mean spending money now or sacrificing potential revenue by foregoing certain practices in the name of ESG. As a result, mid-sized companies and up-and-coming competitors may lose competitiveness against giant corporations, either because they lack the financial capacity to support ESG or because they miss out on investments and agreements by failing to meet the required ESG standards. In practice, ESG implementation can stifle competition or at least prevent companies from rising to a level where they can truly challenge the world's largest corporations. In this way, a sort of market reservation is created where only large companies can fully comply with ESG standards. This ensures that, at the very least, they can protect their existing market share. Worse still, ESG could serve as a tool to decapitalize competitors, creating room for these giants to capture the market share of those who fail to adapt and ultimately profit even more. For critics, ESG is simply a way to generate even greater profits. It also reflects a blatant contradiction. Blackrock, for instance, which demands diversity within the executive structures of the companies it invests in, has little diversity within its own executive board. This supports criticisms of do as I say, not as I do. What do you think? Profit or social good? In any case, over time, BlackRock and other financial market players have pressured companies to align with the agenda. But now, the focus appears to be shifting. To meet ESG requirements, companies had to allocate vast sums of money to create inclusion departments and other arms that didn't necessarily yield financial returns. In recent years, access to capital was relatively easy, especially with central banks around the world printing money at unprecedented rates and keeping interest rates low. It was relatively simple to secure funds to cover what could be seen as a toll for ESG compliance. The problem is that now, with rising interest rates and capital becoming harder to access, ESG situation has become quite complicated. Without easy access to capital, competition intensifies, since profitability becomes the sole compass for companies, not only to compete but also to survive. In this environment, companies over time have been abandoning auxiliary policies and refocusing solely on their core business, meaning if they're spending money, it should be on what generates revenue. Expenditures are being cut. With these budget cuts, companies worldwide are reducing their investments in ESG practices, especially in the social domain. The focus has shifted solely to profitability, or what BlackRock itself has termed financial resilience. Even BlackRock has recognized this changing tide, favoring financially healthy companies over those merely meeting ESG criteria. Now, it has reduced its support for ESG initiatives to an all-time low. Companies have significantly reduced their support for ESG, even going so far as to eliminate initiatives tied to it, such as the well-known diversity departments, which giants like Microsoft, for instance, have cut. Even advertising strategies have shifted, now targeting the masses rather than specific groups. In other words, as the tide has receded, the market has revealed who was naked and who was genuinely financially healthy. And in times when capital is increasingly expensive, ESG has taken a back seat, and the pursuit of good old-fashioned profit has returned. In the coming months, the market will show its new directions, but it appears that ESG may have lost its place and might return to what it was at the beginning, just an idea. And what about you? Do you think it's a good or bad idea? Share your opinion with us.